What if I told you that the biggest move in global markets right now has nothing to do with stocks, nothing to do with crypto, and everything to do with a silent collapse in global trust? Gold just hit a historic all-time high. Silver crossed a level no one in history has ever seen before. And meanwhile, Bitcoin, despite the most crypto-friendly political environment ever, has completely failed to deliver. So the real question is this: why are precious metals exploding right now? And what does Japan have to do with it? Stay with me, because by the end of this video, the global macro picture will make a lot more sense. Yesterday, gold officially broke into fresh all-time highs with a strong, convincing close above the 4350 level, an area we've been closely tracking here on Market Tape Wisdom for quite some time. At the exact same moment, silver did something truly historic, surging above $70 per ounce on spot price for the very first time ever. This isn't just another rally. This is a statement from the market. Many people believed 2025 would belong to crypto. After all, for the first time in history, we have a US president who openly supports digital assets. And yet, despite that political tailwind, Bitcoin has delivered one of its most disappointing years in recent memory. Meanwhile, gold and silver have completely stolen the spotlight. And there's a very specific macro reason why. A big part of this story starts in Japan. I've talked extensively about Japan on this channel because what happens there doesn't stay there. Japan is a cornerstone of the global financial system. Recently, the Bank of Japan raised interest rates, something that should strengthen the Japanese yen, but instead the yen fell. That confused a lot of people, and honestly, on the surface, it looks completely backward. Even more confusing is the fact that Japanese government bond yields have been rising at the same time. Typically, higher yields attract capital and support a currency. So why are yields up, but the yen is still collapsing? The answer comes down to one uncomfortable reality: debt. Japan carries an enormous national debt relative to the growth of its economy. Investors are now demanding higher yields simply to compensate for the risk of lending to the Japanese government. That's why yields are rising. But at the same time, investors don't want to hold the currency itself because inflation is eating away at its purchasing power. When you look at Japan's economic heat map, the picture becomes clear. GDP growth has been weak. Inflation is still hovering near 3%, and when you subtract inflation from interest rates, real yields remain deeply negative. That means investors are losing money in real terms by holding Japanese assets. This is why the yen is unattractive. You're taking risk, earning low returns, and still losing purchasing power. Now compare that to the United States. US inflation is lower than nominal interest rates, which means real yields are still positive. And yet, even in the US, something strange is happening. US bond yields are rising, while the dollar weakens. That combination should immediately grab your attention. This is happening because investors are becoming increasingly cautious about lending to governments with massive debt loads. When bond investors demand higher yields and sell the currency, it signals something deeper: a loss of confidence in fiat money itself. And when confidence in fiat breaks down, money has to go somewhere. That's where gold and silver come in. Precious metals thrive in environments where trust erodes, where people no longer believe that governments can manage debt responsibly or protect the long-term value of their currency. Gold doesn't carry credit risk. Silver doesn't depend on central banks. They exist outside the debt-based system. This is exactly why the macro backdrop for metals is so powerful right now. On our internal metrics, every major metal we track, gold, silver, copper, and platinum, is flashing strong bullish signals. This isn't just a gold story. It's a broader commodities and monetary trust story. Now, earlier today, US GDP data came in much stronger than expected at 4.3%, significantly beating forecasts. Traditionally, strong economic growth supports the dollar and weighs on gold. But here's the disconnect. Despite strong GDP numbers, consumer confidence continues to fall. People feel worse about the economy, even while headline data looks great. This is the K-shaped economy in action. Massive AI spending, asset inflation, and capital concentration are boosting GDP. While job growth slows, unemployment rises, and the average household feels left behind. It creates the illusion of strength without widespread prosperity. Markets can sustain this imbalance for a long time, but it always carries consequences. From a trading perspective, I remain bullish on gold. I'm managing risk by trailing stops and allowing the trend to do the work. If price retests prior highs and holds, that's healthy. If it fails, profits are protected. That's disciplined trading. On the equity side, the S&P 500 sits just below all-time highs as we enter the Santa Claus rally window, historically one of the strongest periods of the year. About 70% of the time, stocks grind higher into early January. That doesn't guarantee anything, but probabilities matter. That said, the last 2 years have failed to deliver a Santa Claus rally. A third failure would be unprecedented, but markets love surprises. Technically, trends remain intact across the S&P 500 and Nasdaq, though momentum has slowed. Until we see a clear breakout or breakdown, patience is key. In currencies, strength is showing up in pairs like NZD-USD and GBP-USD, while the Japanese yen remains fundamentally weak. Any yen strength, in my view, is still a selling opportunity, not a reversal. And finally, Bitcoin. Despite improving macro readings, Bitcoin's chart structure remains ugly. Lower highs, weak follow-through, and heavy damage from yen carry trade unwinds have kept crypto under pressure. Until Bitcoin reclaims key resistance levels, patience is the only responsible approach. Crypto has massive upside potential, but history reminds us that drawdowns of 70% to 80% are not only possible, they're common. Risk management matters. So here's the big takeaway. We're witnessing a global shift, not just in asset prices, but in trust. When currencies weaken despite rising rates, when debt expands faster than growth, and when real yields turn negative, capital flows toward assets that exist outside the system. That's why gold is rising. That's why silver is breaking history. And that's why this macro cycle matters more than ever. This is Market Tape Wisdom, where we read between the headlines and follow the real money. If you found value in this breakdown, make sure you're subscribed. And as always, trade smart, manage risk, and stay curious.